Hello and welcome to Brokenomics, and in this episode I'm delighted to be rejoined by Peter.
Dan.
Peter, thanks for coming back.
Thanks for having me back, Dan.
It's very good. So we are going to try and pick up sort of where we left off last time. We kind of had a plan last time and we kind of went sideways. It was an interesting chat.
Yeah.
But let's see if we can get into the nuts and bolts of investing this time. One of the things I wanted to start with is you ended the last podcast that we did on expectations and knowing your investments.
Yeah.
And I thought that would be a good place to start, because I've got to start this podcast by saying, none of this is investment advice. Yeah. Don't take any of that. But your point about knowing investments, that reminds me of one of the most common comments that I get with some of these videos, which is something like, just tell me what to buy.
Yeah.
It's not talk me through the logic of how you arrive at the decision in the first place.
Yeah. Or
necessarily think about the set of skills that you need to acquire to build up a view in the first place. It's they kind of just want to cut straight to the end, which is tell me what to buy.
What's going to go up 100% in the next year?
Yeah.
I wish I knew.
Yes. and that's kind of so dangerous, because let's say we did. We did do that. We just we just floated out our most our top ideas.
Yeah,
they wouldn't know when to sell them.
Yeah,
or when to take money off the table.
Yeah, fair point.
Or necessarily whether it's worth holding through on some of these.
Yeah.
So that was the first point that I wanted to make. Be careful on anything that we talk about here today. But we're really going to be talking through the ideas behind it.
Right.
So,
okay.
First question might as well lead into: should you pay off your mortgage?
Good question. I would say it all depends.
Yes.
If you're locked into a fixed rate deal that is below the current market rate, then it's probably a cheap form of financing.
Yes.
And why would you pay it off now? I think if you can afford to pay off your mortgage, it's always a worthy thing to do, to be debt-free. It's nice not to have debts. But if you can use it as cheap financing and you think you can generate a return over and above the cost of the mortgage, then yeah. I mean, run it.
I notice people like Jeff Bezos, Mark Zuckerberg, Elon Musk, they all have mortgages on their property.
Yeah, personally, I don't have a mortgage. I think it's a nice position to be in.
Yes.
That said, I'm kicking myself because I could have leveraged up a year ago.
Because it's a very easy way to get a very low interest loan.
Yeah. But I just, personally, I'm a very cautious individual. I like owning the asset of your own house. I like owning it. It's mine. But yeah, I fully understand people who use it as collateral to get cheap finance.
Would it be easy if I said, what about student loan then?
Right. Never had the opportunity to be a student with a loan. I don't know,
because those are ultra low rates, and
but are they? Are they not linked to base rates? And base rates are higher now.
That's a good point. That might be the case.
So what was 0% financing this time last year is probably a bit more expensive now. Yet again, I mean, I am just so ultra cautious. I just don't like debt, personal debt.
Yes,
I can see how it works in a business. I mean, businesses should have debt in them, but having that millstone around your neck when you start to earn a decent salary after you've been to university or college or whatever, I just think you probably want to get rid of it as quick as you can.
Because I've always looked at it and thought, okay, well, I mean, I could pay it back, but then my portfolio would commensurately go down. And I've always kind of got this feeling that I could invest at a greater than, whatever it was, 1.25% that the mortgage rate was going for. But yeah, totally take your point. Now rates are starting to climb. That dynamic completely changes.
I mean, you're sort of touching on a bigger issue there. If you go back 18 months ago, we had the TINA trade in equity markets. TINA was, there is no alternative. You have to own equities. Well, now there is an alternative. It's 5% yield on a money market fund or a treasury bond. So, I mean, personally, I don't like debt. I can fully appreciate how people will use debt to their advantage.
And also it sort of explains, doesn't it? When you look at it like that, it sort of explains an aspect of why markets fell as much as they did when rates started to go up. Because, now all of a sudden debt becomes more expensive. So if I was doing that same calculation of do I want to pay off the mortgage versus lower my portfolio, when interest rates were basically nothing, and Tina, there was no alternative to stocks. I mean, primarily it was around a handful of tech stocks, as I'm sure we come on to.
Yeah, we'll come on to that.
It made a lot more sense to do that. But all of a sudden, when the dynamic changes, you feel the need to sort of go and do that and pay that down, and then you can see that money being pulled out of the market.
Yeah. At probably the wrong time. That's probably when you should have been leveraging up because everything was dirt
counter-cyclical.
cheap. Yeah, but yeah, but I mean, the debt thing is, I suspect that is just down to personal preference. And my personal preference is, pay off the credit card every month. In fact, there should be an order here for debt. Pay off the most expensive debt first. So clearly credit card first, personal loans, and then if you're in a fortunate position, why not chip away at your mortgage? Especially when rates, I mean, I hate to think what mortgage rates are now. Base rates at 4.5, mortgage rates are going to be 5.5,
it's just I often find myself talking about how it feels to me that it's inevitable that the value of the pound and the dollar is going to be significantly weakened over the next 20 years.
I think every fiat currency is going to be.
But that also means the value of your debt is going to be significantly chipped away.
There is that, So, I would accept that. But I personally is just so cautious. Everything I own is debt-free. It's mine. There's not going to be a knock at the door one night saying, you're out, mate.
I'm extremely comfortable with that sort of level of risk, but I think for most people, you're probably right on that one. But
I'd rather get my risk in other ways, in assets, investments that I know I can sell tomorrow if things go wrong. I can get my leverage, operational leverage, gearing through companies or whatever. So
should you pay into a pension?
Oh, I'm glad we're starting with the easy questions.
Yes.
Jesus. Right, again, personal preference. It's a trade-off, isn't it? There are tax efficiencies with pension investments, but that money is trapped until you are old enough to take the pension. Therefore, it is potentially captive to, I think we touched on this last time, the sort of the Russell Napier government capture trade. Yes. They could, in fact, they are trying to dictate the investment policy of certain pension funds. So I don't like that aspect of it, but you've got to remember you are getting tax relief at source on that, which is...
So I guess the really pertinent thing is, how old are you now?
Me.
Well, no, not you. The person considering the pension.
Yeah.
So if you're on the verge of retirement and you can put money in and then a few years later you're going to take it out, I mean, absolutely. Fire as much as you possibly can into it because you get that tax deduction at source. But if you're in your 20s at this point, the standard advice is always, and of course, standard advice you should definitely do this is prioritize the pension.
But why say 20s? I mean, kids can have pensions. Most people don't realise that. I mean, I have to say both my kids have got pensions and they're significantly younger than 20 because you then have hopefully a time horizon that is really significant. If you start paying into a kid's pension at, when they're teenagers, they've got hopefully a 40, 50 year time horizon.
My big concern on this is that if you've got 4 decades until you're able to touch that money, the possibility that a government isn't going to steal it in those intervening 4 decades seems remote to me.
Yeah. I mean, they haven't done it for the last 4 decades, and I live in hope. Well, maybe it's a false hope. I live in hope that they will.
4 decades of easy money versus, the situation they're in now.
Yeah. Yeah. I think we can make money over the next 4 decades. I hope to be at the end of that period to see if I was right with that comment. But I mean, it's a difficult one. It's personal preference.
Yeah.
And I guess you've got to look at it in the greater scheme of things. You're going to have to invest anyway if you've got assets. So why not put some of it into a tax-efficient vehicle?
Tax-efficient vehicle, I totally agree with. I mean, there is, I don't know what the situation is so much with the US, but certainly in the UK, you've got ISAs, of course.
Yeah,
so
absolutely.
I think it's 20 grand a year at the moment.
It is,
that you can put into an ISA. So if you're a couple, you can put away 40 grand a year.
Yeah,
and you get the tax benefit's a little bit different. You don't get it as it goes in, but you get it as it
on
comes
the way
out, which if you invest well and it grows is potentially more attractive and you get your income out of it tax-free as well.
But if we get to the scenario where the government's thinking of stealing your pension, you're not telling me they're going to leave ISAs alone.
No, but you can pull it potentially if you spot it.
Yeah.
Before it happens.
Yeah, good luck with that, Dan. I mean, if you've got perfect timing, you can pull it. But yeah, I mean, I think it just needs to all be part of a sensible structure for your assets. I mean, I'm not a financial advisor. I deliberately avoided all those exams to avoid these sort of questions. So thanks for starting with those two.
Should we be really concerned about government debt?
Right. Oh, okay. A third question. That's a real killer. Yeah. I mean, I don't think concern is a strong enough word. I mean, I think the state of financing of governments is out of control. If you look at what's just happened in the US with the extension of the removal of the debt ceiling, as far as I read the legislation, until for another 18 months. I mean,
yeah, they managed to sell it as a spending cut on the basis that no, they're not actually going to cut any spending, but they were planning to raise spending by something like 45 billion. I mean, and now they were going to raise it by 42 billion, and therefore it's a 3 billion cut.
Yeah,
which is actually a 42 billion increase. But
I mean, I just the
nature of politics.
Yeah, I mean, the reality is our governments have, I think, pushed us to the point of crisis. We have these massive debts. So debt to GDP in the UK is somewhere around 100%. So that is unsustainable. There's no sign of it slowing down. So we're just adding more and more debt.
It's difficult to see how they could decrease it, really.
Well, they can try and inflate it away, but that's not good.
Yeah.
I mean...
But I mean, okay. So the biggest items in government spending, it's the NHS, it's pensions, I think, then welfare, then education, then military.
Yeah.
So okay, I mean, military has been squeezed and could be squeezed a little bit further.
Well, we've got a standing army of 72,000 soldiers, which is about as useful as a chocolate ashtray. With all respect to them, I mean, they're not going to stop an invasion if it happened. There's not enough of them. Well, so.
I mean, it's tiny. I mean, you hear about the sort of numbers being bandied around in conflicts around the world, and their casualties numbers are
horrific,
multiples of that, let alone the entire army that they started with. So you can't really cut any of those. I mean, I can't even think of a.
So you can't cut the NHS.
No, no, the big ticket items.
Yeah.
So the NHS. I mean, I can't think of a government in my lifetime that has done anything other than promise to increase the NHS in real time. In real terms.
Yeah.
You're not going to cut pensions, not and get elected.
Well, it's going to be interesting because if the financing side of this is unsustainable, and actually you've got more promises coming, so they are debts that are not financed. I mean, there's nothing backing these government pensions. It's a pay-as-you-go system. Yes. We pay in, and it goes out to the people who are due it. I mean, there has to be a default somewhere.
And there's a pretty easy way of projecting this because you know what people tend to draw on the NHS as they age. You know what people tend to draw on the pensions. You know the age of the population. You can project it forward and you can see that it moves from an unsustainable situation that we are in now to an absolute crisis situation by 2040s, I think.
Yeah. And that's where the US is now as well because they're in a worse state. I don't know what the answer is, Dan. I really don't know what the answer is, but it's going to be fun to watch.
I ask it because there are a lot of people who are just completely blithely unconcerned by this. I don't know if you watch the All In podcast, but it's basically sort of 4 Silicon Valley billionaire venture capitalists talking about it. And 2 of them are always going on about, the level of government spending is at crisis point. And the other 2 are just completely unconcerned.
But I think that particular comment could be applied to so many issues in society today. And we better not touch on that in the first half hour of this podcast, but that's where we got sidetracked last time. But I mean, ignorance is bliss. Ultimately, people do not want to confront the big problems.
I'm seeing people who I don't think I can call them ignorant. I mean, there are a lot of people who are sort of market professionals who are just not concerned about this, and I don't know what's going on. I mean, is it the Emperor's New Clothes? Are they just blind to it? Are they just smart people focused on narrow issues?
I guess they're very busy in their personal lives and their professional lives.
Or is it they just genuinely think, okay, well, the US has always come through in the past. Growth always takes care of us. These things always seem overplayed. With hindsight. And to be fair, in the past, they always have been.
I mean, it's akin to driving your car by only looking in the mirrors, isn't it? You don't see what's in front of you until you collide with it. Yeah. I mean, and I suspect that's where we're going. There will be a collision. And then you are having to trust the leadership to navigate us through that collision.
You got any thoughts about what it starts to look like when it starts to play out?
Well, it's not pretty. but it will create opportunities. And this is an investment podcast, so let's keep on the volatility, which is what would happen from a collision of government finances, will create massive opportunities. And I suspect you do not want to own government debt. That's a long-term comment. Now, I do suspect at some point in the not too distant future, monetary policy is going to reverse, and you will want to own government debt as the days of owning government debt as a long-term trade are over. They are now going to be short-term cyclical investments. And we touched on this last time, that downward slope.
I mean, you can buy sort of 2-year government debt. You can probably buy less than that, actually. Does it go down to 6 months or something, whatever it is?
Yeah, T-bills are a month, aren't they? So, you can go... I mean, if you're in the position to do it, not all platforms will do it for you, allow you to do it. But,
I think in the US, they've actually got a direct Fed service where you can actually sort of go directly and go and buy stuff.
I'm not sure you can do that as a UK resident. I'm not sure, but I think you would have to be US resident to do that.
Could well be the case, yeah.
But, I mean, a money market fund will pay you, in the US, 5%. So, you're getting a similar return, because the money market funds own a lot of these instruments anyway, and give you the added benefit of diversification. You're not just buying one or two issues.
So this is to say, if you think there's going to be an inflection point, you're saying that interest rates are going to start to come down again?
I suspect we're somewhere near the top of the interest rate cycle. Now, I'm not saying they're going to cut rates immediately as soon as we peak, so I think there will be a period. It could be quite a long period of rates staying higher than is comfortable. Yeah,
I mean, historically, the pause between the peak, as in you stop raising, and then the first cut is normally less than 2 years. I mean, pretty much all historical examples show that within 2 years you're cutting again.
And I think that's probably right again. But I think markets at the moment are probably discounting the peak and then cuts within a matter of months. Now, my contention there is if they cut dramatically and quickly, there's a reason for that. Something has gone wrong. Now, we don't know what that will be. I mean, I would look at the banking system creaking as maybe one potential catalyst for instant cuts. That isn't positive for risk assets. So I think you need to be quite nimble but cautious here. That would be... I'm not allowed to give advice.
Because markets are sort of taking the attitude... Because markets are quite buoyant at the moment, aren't they?
So, now, we'll come on to that.
Okay.
A certain aspect of markets are quite buoyant. And we will come back to that. We'll stick to the list and we'll come back to that. Yeah.
Because the market feels that there's going to be a turnaround and it's going to happen quite soon.
Yeah.
They priced a lot of this in.
Yeah. And I've actually got some observations on when the turnaround happens.
Okay.
I think that might mean, we'll go into detail in a minute, but the market might not actually go up when things become more positive. But we'll touch on that in a bit.
Yes, the expectation that the rates are going to fall, and that's going to be good for markets, and therefore everybody is staying more invested than they otherwise would be. But actually, the thing that could drive those rates to start going down again will be so bad that actually you wouldn't want to be invested.
Yeah, it'd be a risk-off environment for a period.
Yes,
and then they'll cut rates.
Yes,
and then you need to reassess and come back to the original point. That's when you need expectations about when certain assets perform, at what stage in certain cycles. So this expectations thing is quite important. So as an individual, you can't know everything about everything. It's just impossible. I mean, your big, massive asset management companies have analysts, coming out the doors, basically. I've always tried to focus on a few areas and have expectations on a few investments. Try and work out when they're most likely to perform and underperform, and then invest accordingly. So the analogy I used to use when I was a professional investor was investing is like doing a jigsaw. But the problem is no one gives you the picture. So you have to create your own picture. And the other issue is you don't have the right number of pieces to recreate that picture. You have far too many pieces. You have tens and tens of thousands of pieces, be they bonds, equities, funds, ETFs. So get to know enough of the characteristics of those pieces, and then when reality comes and you think you can see the future, your picture, slot the pieces of the jigsaw in.
Yeah.
But be very prepared to change your mind.
Yes.
You always reserve the right to change your mind. It's better to accept you're wrong when you're down 20% and sit there hoping to get back to your in price and be down 80%.
Yeah, a lot of people do that, don't they? They think they can tough it out.
I'll sell it when it gets back to what I paid for it. Well,
yes.
That may never come. I mean, just you look at Japan since 1989. And also its opportunity cost.
It comes back to the first point. You really need to know your investment. You need to understand the level of volatility of what it is that you're going into.
Yeah.
Because I mean, if you buy, I mean, I know people who sort of bought Bitcoin near the peak and then it sort of went down, and then they did sell it.
Yeah.
Now, okay, I mean, so far that seems sensible, but you had people who were sort of doing that back when Bitcoin was 1,000. It went down 70% and they sold it, and now it's
28 or
a
something.
great multiple of that.
Yeah.
I mean, that's a more extreme volatility example. But it comes back to the point you have to understand your investment. You have to understand these issues around timing and risk and volatility,
and what the drivers of that investment are. What particular stage in the cycle will that investment be a buy or a sell? And
we can probably tie that back to some real investments as we get
we can do in a bit.
One more easy question before we get a little bit broader. Should we be really concerned about commercial property?
Yes, very.
Right.
Very, very concerned.
Right.
In fact, I've had an investment meeting with a company I'm involved in this morning, and a lot of the discussion was about commercial property. We were looking at it the other way. We don't own any at all. Where's the opportunity coming? And I have to say, I mean, commercial property is getting it from every angle. So you've had long-term considerations like the growth of the internet, no one shopping on the high street.
Yes.
That's a sweeping generalization because quality high street property always has a place, but marginal high street property, I mean, you only need to look at your local town, is really suffering. But now we've got this whole back to work phenomenon, or not back to work phenomenon, that seems to have caught on. A lot of office space is now empty. Just look around here, you can see it. I mean, there's new offices going up, and I do question.
Well, I mean, all of that would have been commissioned
3-4 years ago, at least.
Pre-COVID.
Yeah, pre-COVID, definitely. Yeah. So, there's that. I think industrial is probably okay.
So I used to look at commercial property maybe 3-4 years ago, and it was interesting how the market split down, because basically what everybody wanted were, we call them sheds, which are these big, when you see
distribution centres.
These just big metal hanger, like aircraft hanger things, where Amazon goes in, and Bed Bath and Beyond, the distribution type centres.
Well, Bed Bath and Beyond won't be in it anymore.
Well, yes. But everybody wanted those, and the yields on those were sort of somewhere between 1% and 2%, because they were so popular, everybody wanted them. Then you got the office spaces, which pre-COVID didn't look like a particularly bad deal. If you were buying prime office space, they had yields of somewhere in between sort of 2% and 3%. And then you had high street retail that was sort of up there between sort of 9% and 12%. Nobody was interested in high street retail for exactly that thing, because of the online phenomena, where the value of online of traditional retail had just evaporated, and it looks like that same thing has just happened to office spaces.
Yeah, and you're missing the one that's really suffering: entertainment venues. So pubs, specifically pubs and restaurants. I mean, just look around you. We'll come on to talk about signals somewhere in this podcast. What's the world around you telling you? Look at how many empty pubs there are in the world today, and they have been killed by COVID. Several of the missions that I set myself during COVID was, one, learn how to do a really good pizza, and learn how to do a really good. I mean, I can basically replicate most of the stuff on the Chinese takeaway menu now, just because I sat there with YouTube. I got nothing else to do, so I went on YouTube videos and learned how to do all this stuff. The amount of people who must have done that, and your habit has just sort of changed. It's not dinner and a movie anymore. No. It's it's cook or get something in and watch it on your 65-inch screen. Yeah, and if you do go out to dinner, I mean, God, we family of four went out to dinner the other night to Prezzo. So nice.
Oh yeah,
160 quid.
Yes,
no booze. Yes. 160 quid. Yeah. I mean, that's a treat now. And that is not an everyday occurrence.
And the other thing I'm finding is we started going back to restaurants that we hadn't been to for a couple of years. Yeah. They've been so hammered by inflation that the portion size were ridiculously small.
Shrinkflation.
Yes.
Yeah.
Oh, I mean, only one of them, I kind of almost thought, well, I'm going to have to order a second one. Just to... Yes. I mean, I know I'm a bit...
We won't expand on that one, Dan. But I mean, I think the reality is, and there's an interesting sort of subtext to this, quality is always worth considering. If not investing, always have a certain amount of quality on your expectations list. But
so quality office space?
Quality office space, quality entertainment venues, quality retailers. I think that's always worth a premium.
But I mean, even prime commercial property is getting really beat up at the moment. I mean, we talked through an example, didn't we, earlier of LA and California and San Francisco office
carnage,
space.
Absolute carnage.
Yeah,
now they've got other idiosyncratic reasons. Right? I mean, when you look at what's going on in some of these inner city American places, I mean, they're horrendous places. But I mean,
the Democrat run. So
there was one property that I think it was LA, came on the market for $350 million, distressed sale, and it actually went for 60. Now that is a markdown and a half.
And you've got to wonder
someone's
what
financed
that.
Yes, the debt point. I mean,
what was the debt on it? It's going to be more than 60, isn't it?
Yeah. Which is why I think there's sort of been a massive sigh of relief that the banking crisis in America is over. I'm not so sure.
Okay.
I mean, I think it might have gone into hibernation, but I think and the trouble with commercial property is it's a very long run asset. So I mean, a lot of these commercial properties are going to have debts that don't fall due for 5, 6, 7 years. So this is going to take a long time to work through the system.
Okay, I mean, just to touch on that, the banking crisis thing is over. Part of it is I mean, a lot of those banks are holding collateral which is on these commercial properties.
Yeah, for sure. Yeah.
These commercial properties, occupancy is falling, and it would probably fall significantly faster if people could get out of their leases early. Yep. So there's going to be a whole bunch of people who the moment their lease is up in 2 or 3 years' time, they're out of there.
Yeah.
So no matter how bad commercial property looks now, it's obviously far, far worse than that.
Potentially,
that then feeds back through to the banks who are holding this as collateral.
Yep.
And then everybody's going to be in this worried position at the moment. I don't want to write anything down.
Yeah.
Because as soon as it starts to look like I'm going to need to write down my collateral, when we saw what's happened with Silicon Valley Bank, they lost whatever it was, like 42 billion in an hour.
Yeah, it was a day, wasn't it?
Yeah,
welcome to the digital economy.
The money just sort of moves. So as soon as anybody goes first and say, okay, I'm going to be brave and I'm going to write down the value of these assets to something realistic,
they're going to get hammered.
They're going to get hammered.
Absolutely hammered.
I mean, it's okay if you're the 200th bank to write down your collateral, but not if you're the first. Yeah. Nobody's going first.
No.
So I kind of feel that's what's happened with the banking crisis. Is it's just on pause because everybody's like, oh, somebody else blow up before me.
So bring that back to the audience today. Personal investors. That's just too difficult for me. Commercial property. Right. And you've got to look at the structural issues in the UK commercial property market as an investor as well. We have open-ended commercial property funds that deal every day, whose assets are, the valuation of them that they're being held at, to me, are questionable. They're probably lower.
There's a whole load of REITs, isn't there, and investment trusts. But
REITs, you probably could. There's always going to be a market for a REIT because it's effectively a closed-ended investment company.
Yes.
And it's going to trade. It might trade at a massive discount, but there'll probably be a buyer on the other side. We know the gates are going to go up on these property funds if they get too many redemptions. So if I was an investor, I don't care what the loss is or the paper loss on that is. I'd realise it now.
Are you saying you're okay, this comes up again to the first point about know your investor. Are you saying that potentially you're on the lookout for massive volatility here
in commercial property
as a sniping opportunity?
Not yet.
Okay.
Personally, not yet.
Have you been? Because I know you're involved in property. Have you been looking at any commercial property?
No. Okay. Too expensive.
Because one of the things that people are going to ask is, why can't it just all be converted into flats?
So put my property development hat on now because I do own a property development company. Very difficult to do. A lot of these buildings they're not plumbed in and the electrics are wrong and it's all the cost of converting a block of flats. An office property to flats. It's every property's idiosyncratic. It's its own building, but you've got to weigh it up. And in most instances, it's difficult to do and expensive. So we have looked at this a lot and never done it. Now, if these buildings are going at very distressed valuations, then we're going to consider it, but not yet. And as an investor with a property, if you had property in your portfolio, I think you really need to do your analysis on that.
To watch the full video, please become a premium member at lotuseaters.com.